My name is Rod Turner. I am the founder and CEO of Manhattan Street Capital. I have had the good fortune to play a key role in building 6 successful startup companies prior to this one, 2 of which we took public to the NASDAQ. One of those is Symantec, the Norton antivirus company. My team launched the Norton antivirus. Had a lot of good fun there. I've also done a venture capital firm in the late 90s called Irvine Ventures, which was a lot of fun, and I learned a great deal from. I launched Manhattan Street Capital, started the company in April of 2015 because of Reggae Plus, focused on Reggae Plus, and we launched the platform initially in May of that year. So we've been live for 5 years at this point. Actually, in 2 days' time, we'll have been live for 5 years, focused on Reggae Plus offerings. Manhattan Street Capital is focused on, obviously, on Reggae Plus. We do select Reg D offerings also, and we are selective. We're both a platform as well as a project management and advisory service to help companies succeed. We're very different in the way we operate than our competitors in that we are selective. We say no a lot to companies when we don't think they're likely to succeed with their offerings. We help advise companies up front as to if they should use Reggae Plus or not, or Reg D for that matter. We are not a law firm. We're not a marketing agency. We utilize such. We're not a broker-dealer. We're essentially, we act as quarterbacks. We bring together all of the necessary service providers to help you succeed with your offerings and manage and interact with them and with you to the maximum extent we can within the regulations to be of help. We're not valuation professionals. We're not underwriters. And so, you know, if you think you're getting legal advice from me, you're not. I'm giving you help. And you should check with your securities attorney. If you think I'm giving you valuation advice, I'm not giving you specific valuation advice, et cetera, et cetera. So just bear in mind those kinds of disclaimer points. Again, use the speaker view. You'll probably find that will give you the most useful experience here in this presentation. So now I'll get started with the agenda. What's unique about Reggae Plus? It enables us to much less expensively promote an offering and raise money. So many folks were not able until Reggae Plus to invest in companies that they love doing really interesting things. And it was essentially restricted to accredited investors. So if we're marketing an offering that can be explained succinctly via social media advertising and PR, then we have a good chance. And if it's engaging as well, we have a good chance of bringing investors in at relatively low cost. So a good example of that we'll get into with the Biotech section is one where they were spending $3.30 to 50 cents, $3.30 to $3.50 for every $100 that they raised in terms of online advertising spend through social media platforms. That's about as good as it gets in terms of marketing expense. In a Reg D, it costs a lot more. And if the company is difficult to explain, obviously it doesn't work quite as well, which is one of the important characteristics of Reggae Plus, is to promote, to do offerings where they appeal to consumer/Main Street investors, which is where we have the big advantage because it's so easy for them to invest modest amounts of money and so easy to engage with them. The kind of people who invest via Reggae Plus into Reggae Plus offerings tend to be more optimistic in nature than you might expect. I have friends who would never put their credit card on the internet to do anything because they're too concerned about that. So those folks aren't going to be the ones doing Reggae Plus investing. It has to be easy to invest, and it is nowadays. You know, we keep on improving the investment process for ease of use. It's now down to 4 to 6 minutes on a smartphone, and 60% of the money in a typical Reggae Plus now is coming in via smartphone investors, people who actually complete the transaction on the smartphone using a debit card or a credit card where the issuer company chooses to use those payment methods. It's been really impressive to see that, how big a shift there is there. It's important to not be a broker-dealer platform when it comes to the convenience of investing, because a new investor arriving at a platform that is a broker-dealer has to answer so many questions to satisfy the broker-dealer's requirement for FINRA. FINRA requires them to know the customer really well in order to open a new account. So one way or the other, it turns into a very, very lengthy journey, and 4 to 6 minutes is out the window. We are not a broker-dealer, and that's one of the big reasons we chose not to be. An advantage in Reggae Plus is that you are building a brand and selling products and services whilst you are raising money in many cases. Of course, it depends on the nature of the company, but in many cases, you're doing just that. So the cost of promotion can be shared with building the business, not just spent on the, raising money. You get better valuations typically in a Reggae Plus than you would in an angel deal or a venture deal or a typical Reg D deal. That has to be monitored. We have to be careful with that. But you see significantly lower dilution in typical Reggae Pluses. That's one of the things that is attractive. You retain control of the company. You don't necessarily give away board seats the way you would if VCs were investing. You have the option to start out your Reggae Plus as a plain vanilla Reggae Plus and then convert it towards the end into a Reggae Plus IPO to the NASDAQ. And that's a nice option. You can also complete a Tier 2 Reggae Plus and list it on the OTC QB or QX and retain the limited reporting options that are part of Reggae Plus. So once you've completed your Reggae Plus Tier 2, it's required that you produce an annual GAAP audit, US GAAP audit, which isn't too onerous, and 6 monthly management financials. That's the same reporting requirement you'll have on the OTC QB should you take that path. If you went to the QX, then you would need quarterly financials, but still only an annual US GAAP audit, which is so much less onerous than if you had acquired a shell company that had downlisted from the NASDAQ or the NYSE in the past. In fact, one of the things that's not so well known about Reggae Plus is that it is actually a public offering. And if you don't lock the shares or the securities in your offering, the investors are liquid as far as the SEC is concerned, which isn't the same thing as saying you have to list the stock. But if an investor owns a security of your company, they're allowed to sell that security to any US person or any real non-US person without any particular difficulty beyond the fact that they would like to do it via a platform or they'd like to do it via a market. That is where liquidity comes in, and listing on real markets is something which is happening slowly. That is to say, secondary markets for Reggae Plus are coming on stream slowly to provide actual logistical support beyond just 1 or 2 broker dealers here and there that will do those transactions. But outside of the security you're offering, once the company has completed its Reggae Plus and filed either its management financials or its annual audit, then all the insiders are considered liquid for whatever securities they have, as long as they've passed their Rule 144 holding period. So long-term investors, founders of the company, are all considered liquid, although insiders and shareholders that own more than 10% of the company are restricted as to how much they can trade and when you're an insider or a major shareholder. But passive investors who've been in a company for a long time will be liquid post those reports. And if you do a quarterly report every quarter, which is an option, then they'll be able to be more liquid for longer periods of time. One of the things that's nice that I hadn't really anticipated is that because a company has to qualify with the SEC to make a Reggae Plus offering, that is to many people, an endorsement or a credibility statement. You know, the amount of work involved in getting your company qualified by the SEC is significant, and you don't get through that like walk in the park. And so we do find companies having an easier time getting joint ventures and other strategic arrangements together because they've been able to qualify for Reg A Plus with the SEC. A couple of metrics on Reg A Plus. We have more of these numbers on the Manhattan Street Capital website in our FAQs and blogs and news announcements. $1 billion plus, just a bit more than $1 billion, was raised via Reg A Plus in 2019. That puts it on a par with the entire private placement industry, which raises about $1 billion a year. So it's still way smaller than it can be, but that was 40% growth year on year over 2018. The average company using Reg A Plus raised 20 million in the year 2019. It doesn't have to be expensive or remarkably slow and time-consuming to do a Reg A Plus, but it isn't a walk in the park trivial item either. I'll get into cost and schedule later. The downsides of a Reg A Plus are that there are limits as to how you can promote it. It's more limited than in a Reg D, for example. You are not allowed to make predictions of success, predict schedules of deliverables that you'll accomplish, because the SEC wants to protect novice investors from such. It takes time to prepare. I'll get into that later. And you have front-loaded expenses. You have to get an audit done if you don't already have one, going back 2 years if the company existed that long. And you have to bring a securities attorney in unless you are one in order to make the SEC filing, and that costs. And you also need to be able to make the offering, market the offering, prepare the right content to make an online offering. None of that is free. It all costs money. I'll get into that. And at the moment, the cap on a Reg A Plus is 50 million per year. So, okay, moving on to the next item, which is Reg A Plus in biotech. We find that biotech is one of the most attractive segments for Reg A Plus offerings to us, because many of the companies that many biotech companies have some of the lovely characteristics that make them resonate to the Reg A Plus audience, to consumer/Main Street investors. As an example, In Situ Biologics, we completed a Reg A Plus with them a few months ago. They had very low cost of marketing, a very low cost of offering, and a lot of beautiful engagement. Many anesthetists and doctors invested because they could see how the company's offering works. They make a preclinical non-addictive, non-opioid painkiller, which the initial use is for surgeons to insert in the location of a surgery before they stitch up the patient, and then the painkiller gradually, slowly is absorbed into the body, producing pain-killing effect where it's needed, without the need to pop addictive pain-killing medicine. So it's an appealing, very timely company, and they had a lot of success in their Reg D with us, where they raised $500,000 quickly, and with their Reg A Plus, where they had good success also at low cost of marketing, which I mentioned earlier. So the Main Street appeal, the emotional appeal, when you look at where Reg A Plus works best, there are two sweet spots. One sweet spot is Main Street consumer investors who either want the product or service themselves, or they want it to exist because they believe it's important to their life and the life of those around them. So In Situ Biologics, maybe a lot of people that weren't suffering pain, they're anesthetists, doctors, and others have friends and relatives that they're worried about dealing with addictions and so forth. That was a big part of the appeal of it. Companies that make cancer treatments today, Corona, COVID-19, test devices, treatments, vaccines, all of those things are remarkably appealing right now. People want to vote with their feet, even if they don't put a huge amount of money in place to feel good about themselves. It's not only about making an investment and making a profit. Of course, making a profit is important, and that's where we get into real estate, which we'll cover later here. How we're doing on time, got to keep moving. This is, by the way, mentioned in the agenda, mentioned on the promo pieces for this webinar. We're covering a lot of ground, so I do need to be relatively brief. I can't cover everything in as much detail as I might otherwise do. We'll do that later. It has to be easy to explain the biotech company, medtech company, but when you're dealing with cancer, Alzheimer's, when you're dealing with, I'll come back to that. Yeah, when you're dealing with concerns that the user has, like addiction, then a biotech company can be remarkably appealing. If it's dealing with some really unattractive human process, then it's going to be a lot less appealing. It has to be easy to explain it. And when you're promoting it, a tip here, which is kind of obvious, but not always, is that you have to avoid jargon. The fact that some medical professionals can figure out what you're saying and decode the video, decode the content, doesn't work very well for Main Street investors. The second sweet spot, I mentioned 2 sweet spots in Reggae Plus. If we see somebody investing $30,000, it's typically somebody that is almost accredited. They've been chomping at the bit to invest in neat companies they believe in, while their buddies who are accredited have been telling them how wonderful it is, probably amplifying, exaggerating their stories, but wanting to have a chance to do the same thing, and now they can. So that's where we'll see larger dollar investments typically. And because of the way that biotech companies can resonate, then it can be a low-cost thing. So as I mentioned earlier, $3.30 to $3.50 in media spend to raise $100 online, in a Reggae Plus offering is a thing of beauty when you don't already have an audience, which is the case for that in-situ company that we helped. Real estate is the largest segment of success in Reggae Plus, over 65% of capital raised to date. I'll get to the questions. There's some nice questions arising there. I'll get to them a little later. Real estate has been very successful. When you see companies hitting the 50 million maximum, more often than not, they are real estate transactions, debt or equity, usually debt. A lot of REITs, but not all REITs. There's been a model that Fundrise in particular has established. They've done over 15 Reggae Pluses now, multiple parallel offerings with one shared management entity that doesn't own each of the individual entities making their offerings. They've raised, last time I checked, close to $700 million in Reggae Plus, probably far in excess of that now if we go back and check. The reasons why real estate resonates, it's been a good cycle already for a while, since Reggae Plus came to exist. The fact that many real estate offerings can afford to pay interest dividend payments as they go is very helpful. The fact that it's easy to understand real estate. Lots of people think that they are experts in real estate. You have a secured asset. It's not like a startup company where the talent could all get really upset and walk out the door next week on Thursday. In a real estate offering, the security of owning assets is a nice reassurance. Because of the interest payments, a lot of investors like that. They like the fact that they can make a decent interest return on their money through real estate, whereas these days it's so difficult. We're almost in a zero interest rate environment now. So for regular people to be able to earn 6, 8, 10% interest on their money is a very appealing thing to a lot of people. I hit on a couple of the metrics earlier. I was going to bring them up again. So real estate, next item, secondaries. The SEC extended in December of 2018, they expanded Reggae Plus to encompass reporting companies and allow them to do secondary offerings via Reggae Plus. So there hasn't been a whole huge number of them, but there are quite a few coming through the pipeline now. Many of the companies doing these offerings have penny stocks, which makes it more challenging, a lot more challenging. And that focuses attention on the nature of the security that is being offered. A company on our platform now, Cloud Commerce, is public. Their stock is essentially a penny stock. And they're offering a new security, which is a debt instrument that pays 10% per year, payable monthly to their investors. And they've held back a reserve on capital raised for a year in order to pay those dividends. And they're planning to list the new security as well on the OTCQB. It's priced at $25 per unit, which is a typical price apparently for that space. So that's an interesting way to go about it, because it doesn't convert into the common stock of the company. A couple of advantages for companies doing secondaries: they're usually geared up with the ability to make PCAOB audits every quarter, because they have to be. Otherwise, they're not a reporting company, and they have law firms involved too. So for them, the step up in effort for an audit is non-existent. They already have it. And they also don't have to spend as much money on the legal filing. They're already prepared in the ways of the SEC. The incremental effort in doing a Reggae Plus is smaller. The cost of that securities filing, the law firm fees are usually lower as a result. You still need to... There are two types of investors buying into these secondary offerings. When it's a very attractive financial transaction because of the dividend, then the nature of the business is a little less significant, because the nature, it's a financial transaction. Ooh, I'm getting 10% dividend paid monthly. I like it. And I just need to satisfy myself as an investor that the company will be around, and that I can, that I find that a stable enough source to want to take some risk, albeit not in many cases equity risk, to put my money in play. If, however, the nature of the offering is based on a straight stock secondary, then you got to do what we were talking about earlier, which is the offering has to appeal to Main Street investors, and it has to be easy to convey via social media advertising, where you do not have a giant space in which to promote and explain. And your landing page for the offering needs to be succinct and clear and easily understood. So, you know, bear in mind those restrictions which apply very clearly in a secondary offering. IPOs. There's been 11 Reggae Plus IPOs to date. We've seen a slowdown since one particular company pulled a fast one with the SEC, and they got demoted. They got their listing pushed down from the NASDAQ. That company gave Reggae Plus IPOs a bit of a black eye and has slowed momentum. We'll see it resurge gradually. There's been some interest there. We see some really good companies coming through the pipeline for Reggae Plus IPOs. The reasons why Reggae Plus is attractive to the company making the offering for an IPO are the following. You start off the Reggae Plus with a non-PCAOB audit requirement, just a simple US GAAP audit, and the law firm and the audit fees can be much lower than in an IPO for that reason. And you have the flexibility. Let's say that the market's difficult, or there's some major setbacks like we're experiencing right now with the COVID virus, then you may not be able to raise enough money to list on the NASDAQ. Maybe your minimum is 14 million and you hit 12. Well, if you were doing an S1 IPO and that happens, then you pack up your bags and go home and you raise zero money, no money at all. Whereas in a Reggae Plus, you can raise a substantial amount of money. You can close. You can do closings along the way. You can raise money without having to meet the NASDAQ minimum. And you could list elsewhere too. But even without listing, you can close and raise money and not have wasted the entire effort So that flexibility is good, lower costs are good, and at the end of the process, when you do list, then you need to upgrade to PCA or B audits post-haste, but you didn't have to do it up until that time. There are some interesting questions about the methodology. It's sometimes difficult to get high quality underwriter attention for any IPO, including a Reg A plus one. And that's where another advantage of Reg A plus kicks in my view, which is that you can, how are we doing on time? 11:30, okay, not too bad. You can raise money online prior to engaging the underwriters. So your company may not be quite sexy enough at the front end to get the underwriters on board, but you can raise money online successfully anyhow. And then when it's clear that this is a successful offering, enough capital has been raised, there's enough buzz and excitement, then it's a whole different story, and we can go to the underwriters for you, with you, in order to get them engaged and create a syndicate and have them do the IPO part. It isn't technically required to have underwriters to do the IPO part. You can do a direct listing via Reg A+, but there haven't been any direct listings yet. Up until now, it's always been an underwriter that's done that last piece. So you can backload that though. But 9 months in and you've already had great success. Now it's easier to get the attention of the underwriters and on more favorable terms. So that can be a good way to go. And I think that's a really attractive aspect of Reg A+. In the event that, I'll give you a tip here, in the event that you do a Reg A+ IPO, then an advantage of front loading the online raise is that you have an online raise system that works well, that doesn't have a broker dealer involved, so that the investors have an easy journey. It's very quick, simple for them. And in the same way, if we help you, or if you're on your own, engage underwriters, you need to make sure that they will not ruin the online dynamic, which many of them will. Many of them aren't sensitive to the mechanisms and the nuances and the user interface aspects and all the heinous questions that investors have to answer. So we know the ones that are good to work with on that basis. That's an important component of the whole. Okay, moving right along. Cost and schedule, I'll hit the high points here. The upfront cost, the minimum I can see you getting away with in terms of the spend that you've made on a Reg A+ that gets you to the point where at the end of the first month, you are now raising more money than you're spending on marketing to bring in that money, which is typically the case. Typically, we get a pretty good ratio, even in the first weeks of testing. Then it's going to cost at least 130K to get to that point, including cash cost, including all expenses. You can spend a lot more, right? I mean, I spoke to a real estate company that had already qualified, and they had spent $300,000 on law firm fees and spent extra months, a lot of wasted time, because the large law firm they tied themselves to were learning the ropes at their expense in charging high billable rates. So avoid that. You know, that's part of what we do, right? We bring the practice service providers to the table that are experts, that know what they're doing already, and that charge modest prices and deliver time efficient results. So that's the minimum. I'd never want you to go into a Reg A+ with only 130K available, but that's the minimum real cost. To get to that point of cash flow positive, if you will, on the capital raising process, $300,000 or $400,000 is more prudent, so you have spare runway, spare cash, and can handle Murphy's Law and other unintended delays and so forth. So that's the single biggest issue of expense that people care about generally. The total cost in a Reg A+ that's above, say, $10 million, if we're doing one that we should be doing, right, not doing one that's hard to market, not, you know, avoiding one that is hard to explain or isn't appealing, sticking with the kind of deal we should be doing, then 10 or 12% total cost of raise, cash cost of raise plus some warrants is a reasonable expectation to go in with. The biggest single expense in that is going to be marketing, unless you use a broker-dealer platform, in which case you'll have the broker-dealer fee of 6 or 7% for the platform and the cost of marketing, which makes it a lot more expensive. So 10 or 12% when you're not on a broker-dealer platform is a reasonable projection for the total cost of a raise of about 10 million. Advertising is the single biggest expense. I'll get into some more tips on that later. Schedule, hitting the summary view here also. It typically takes 2 months to prepare the Reg A Plus filing, the Form 1A, to be sent into the SEC, as long as you avoid using a securities attorney that is learning the ropes. So 2 months. You can make it longer by, big mistake, making the offering the Form 1A, therefore the end result when qualified is called an offering circular, making it into a brochure. It's a big, big mistake, very expensive. People never read them, making it, instead of 80 pages, making it 280 pages and having it pretend to be a brochure just costs a lot of money, wastes a lot of time. Don't do that. But you can get the filing ready in 2 months. You could do it in less time with secondary offerings. We've had it happen faster. And then file it with the SEC. And when it's well prepared, a 2-month journey through the SEC is entirely reasonable to expect. So from the point of starting to the point of qualification, 4 months is reasonable. Then we go live for up to 12 months. And in the first month, 6 weeks, the marketing is going to be low budget spend, tuning, testing and tuning, learning the ropes as to which target audiences, which messages, what content is resonating the best with the investor audience. So you get money right away. Some people in a Reg A Plus will invest on first visit. I think it's a thing of beauty when that happens. Not very many, 1 or 2% of the money will come in that way. But people engage and come back a day or two later, a few days later on the weekend, and invest in significant quantities, as you might expect based on what I've already said. So expect it to be low advertising spend in the early weeks, but also low capital raised in the early weeks for the same reason. And we only want you to step up the spend when the efficiency starts to kick in from the testing and tuning that you do in the early weeks. So, reckon the first couple of months are going to be slow, and they're going to be gradually ratcheting up the expense as the efficiency goes up along with it. And I'll get into the efficiency stuff in a few more minutes. So another important thing to know is that if you want to raise $20 million and you insist on doing it in 6 months or say 4 months, it's going to be really expensive. If you take a whole year to do it, it's going to be less expensive. The fact is that the social media advertising outlets where most of the traction comes from will charge you much higher prices when you spend humongous amounts of money. So if you get impatient because you have to, it's going to cost more. It's going to significantly increase the cost of marketing. Just bear that in mind. It's generally better to take a year. Now I'm going to flip into what's confusing about Reg A Plus, some tripping hazards that people get caught up with. I'm glad to see questions coming in. Tier 1, people tend to think that if you're doing less than a 20 million raise, you should use Tier 1, and Tier 2 kicks in from 20 to 50. Not true. Tier 2 Reg A Pluses can be 0 to 50 million. Tier 1 is used less and less. In 2019, 4% of the capital raised in Reg A Plus was via Tier 1. 96% was Tier 2. That reflects the fact that the biggest advantage in a Tier 1 is you don't need an audit. But then when you go to the States to get blue sky exemption, most of them need an audit. And many of them take a remarkably long time to accept your filing. You're asking permission of the states. Some of the states, like California, in a Tier 1, you have to go do the blue sky request of approval, essentially, from the state. they'll do a merit review. Do we think this is a good enough offering for California residents to invest in? And many other states do the same thing. So tier one is a waste of time in almost every case. Banks are one of the few exceptions. 2-year audit confuses people. If you just started your company, you don't have to have a 2-year audit. If the company existed for 8 weeks, then you're doing an 8-week audit. You don't have, if you are buying at, what's the size of the minimum is an important tripping hazard too. In the early days, people thought they had to have a credible minimum. You know, they're raising, say, targeting $26 million, and maybe they need a $8 million minimum for credibility with the SEC or someplace. Not true. So if you're buying an asset, you know, you're buying a building and it costs 12 million, then guess what? You got to have a $12 million escrow, and you can't close $1 until you exceed 12 million in escrow. But if you're growing the company and you prepare the Reg A plus filing properly, then you can have a 0 minimum, which means essentially in the first week, you'll be doing your first closing probably. If not in the first, then in the second week of promotion of the offering, which, and you are allowed, as long as the offering is prepared properly, you are allowed to use proceeds from the raise to fund the ongoing expenses of promoting the raise. So the cash flow impact in that situation is drastically better than imagine doing a $30 million raise where you have to fund it all out of the company's coffers and can't touch the money that you are raising. That's a lot less attractive. So know that. People tend to think that, like in a lot of other offerings, that you must use a fixed share price. Not true. You're allowed quite a lot of flexibility in the share price / valuation of your company during the Reg A plus. Where this comes in very handy is oftentimes a company say they really need $6 million. They'd like to raise a lot more, but they don't know how much they can raise and how difficult it'll be. But $6 million is the nut. But they can do a minimum, they can do a 0 minimum because $500,000, $1 million, all of that would be useful, but they really want $6 million for a variety of reasons. So they can value their company around that expectation. And then if things go really well in raising capital, they can raise the valuation, raise the share price, and manage dilution ongoing from there. It's a very lovely flexibility in Reg A Plus that is not broadly understood. No, you don't need a broker-dealer. Having a broker-dealer has its advantages. The primary advantage of having a broker-dealer in an online Reg A Plus is that there are problem states. There are states that are not cooperating with the SEC, the worst of which is Florida. If you're a Florida-based company, essentially Florida says, if you don't have a broker-dealer, then you can't raise money in any US state into your company. So if you're a Florida-based company, you might want to consider putting your company somewhere else. But if it's in Florida, then you have to have a broker-dealer in order to raise $1 from anywhere in the US. Bear that in mind. Other states aren't as difficult as Florida, but Texas matters, Florida matters no matter where you are, because significant sized investor audience in both cases. So having a broker-dealer is one of the two solutions to that. The other solution is to file in each state as your own broker. And that can be done as long as you start it in a front-loaded basis. It'll save you some money. We have a broker-dealer we work with for that purpose, for allowing your offering to work in all of the US states without having a problem with the problem states. And they charge a 1% commission, which is the best deal that I'm aware of. It took 4 years to find such a deal. And I still have people telling me it's impossible to do that, although we're doing it on a regular basis. When to add a broker, for that purpose, the one that I just described, you want to add them at the beginning, if you're going to add them at all, because it makes it easier to raise money in all states. But if you want to add a broker where they are going to bring in investor momentum, they're going to bring in their own sources of capital, don't front load that, because frankly, there's almost never a case where a broker-dealer is going to take the risk of reaching out to their investors and recommending your offering when nobody's invested yet. Let's say you're doing a 30 mil raise and you've raised all of $200,000. There's no way that the broker-dealer reps are going to risk their relationships with their clients by having them jump on board yet. It's too risky. They'll wait until, if it's a 30 mil raise, you pass the halfway point, you're at, 16, 17, 18 million. It's clearly a big success. That's the first time they'll go to bat. So don't spend the money on having a broker dealer at the front end until it's clearly a success. And then you get better terms. You can add them in after the fact in an easier fashion in many respects, because if FINRA slows down the filing, it doesn't matter. We're already live. You don't have to stop just because you have a broker dealer coming down the pipe when FINRA blesses the terms. So timing that right, if it's going to be a true value add, which is very rare, do it later when they really will be adding value and they're chomping at the bit, which is what we see on a regular basis. When it's successful, then is when the tire meets the road and the value comes. Okay. I hope you're enjoying this, guys. I can't get feedback in this way. I'm just looking at my picture here. It's kind of boring, but hopefully you're finding this useful. On to tips and techniques and, how to succeed, other important points. Mentioned you can change the share price. One of the lovely things about doing so in the appropriate manner is that the early investors are taking the biggest risk, right? I mean, look at it. You're raising 30 mil, and the person that puts in the first $5,000, how big a risk are they taking versus somebody coming in when there's 28.5 million in already? Huge risk, right? So offering a better share price and valuation to the early investors seems to me to be only fair, and it helps because you encourage the early investors to get off the fence when they can see that subsequently you are actually raising the share price. When you've done that once or twice, it really makes clear to folks who are just sitting on the fence that they might want to invest in this puppy rather than wait for yet another higher share price. It's good to the early investors, and that's a nice thing. And it's not just nice, it's effective in this transparent online funding process that we're discussing here. Zero minimum is critical. If we have companies that set a arbitrary number. Oh, let's do $1 million minimum. It feels credible. I can trust myself more with that. Lovely theory, but now you've got to raise $1 million and spend all the money that goes with that before you can do $1 closing. So all the cash flow expense that goes with that is going to have to be spent. And the credibility factor isn't as good because the early investors, if they pay attention, they know that their investment may be a waste of their time, right? So the more sophisticated investors won't engage anyway until you pass the minimum. Engaging a big audit firm, we had one lovely company that wonderful metrics, significant scale, high growth. They could have been really profitable if they slowed their growth down. They insisted on using Deloitte as their underwriter, as their auditor. They had two international entities and a US entity. They never got an audit from Deloitte in time to make a filing for their Reggae Plus. Not once did that occur. And they ended up, the board gave up, canceled the whole transaction, and got really, really upset with the CEO. Avoid big auditors. Some of them will jack up the price 3 or 4x late in the cycle when it's too late to switch as well. It's a heinous practice, but they can get away with it, and some of them do. Keep the terms of your offering simple. The more complex it is, the more people will say, interesting, I'll think about that and come back. And then they don't come back. You lost that investor. We've learned the hard way that small agencies are the thing to do, with people to work with. Medium agencies, even small medium agencies and big agencies cost a fortune. They come in with very high expectations of how much money should be spent, excessive overhead. The whole advertising agency business is in flux. take advantage of that. Don't fall foul of it. We use microscopic agencies that are really cost efficient and very tenacious and feel like they have a lot to prove and are super cost effective. In most cases, if you're going to do test the waters, be very careful with it because it takes time for one thing. And the biggest mistake is to spend a lot of money on it because the money you spend bringing in people, making you feel good as they make reservations that are non-binding anyway, it's 6 months later, 4 months later, when you're qualified and you're ready and you go back, now you've got to get their attention all over again. You know, they may have relocated, they may be on vacation, there could be some other big change in their lives, or maybe they just forgot why they were interested in the first place. So re-engaging is usually very difficult. There are exceptions. We've had a couple of notable exceptions, but I can't get into that in this time frame today. We're going to run out of time if I do. Have a low minimum investment amount is really important because when you are engaging through social media advertising, which is what works, you're engaging investor interest. They come in, you've got about 10, 12 seconds to get them to stick around for 30 seconds to look. If their first interest is, do I like it? Am I allowed to do this? Can I do this with play money? Because if I can't do it with play money, I'm gone. They don't know yet how much they love your company. So if you have a minimum of $2,000, it's the kiss of death. Those folks will arrive and leave immediately and they'll never come back. And the cost of your marketing will double or treble or quadruple. You may just fail. So make sure you have a low enough minimum to engage investor interest. $250, $300, $400, $500 in that range is a sweet spot where people will stick around. Typically, they can afford to play with that amount of money pretty casually. And oftentimes people will put in $1,000, $1,500, and then they like what they see, they stay on the email list, they monitor what the developments are, they may invest more. They'll often come back from their managed IRA account and put in $10,000. So, you know, opening the door and letting them in the first place is the smart move. The metrics that I've observed in calculating the minimum investment price, if you will, versus the average actual investment, going out and instrumenting successful Reggae pluses that we've done and others have done, it's about a 6 to 12x ratio in many cases. When you have a low enough investment minimum, then the ratio of minimum to average is 6 to 12x. So don't worry too much about that, right? That's the point here in my book. Okay, timing, yeah, running short of time. If you're going to use a offering platform, there are a lot of advantages because we know what we're doing, we know the right service providers. Don't use a broker platform because they'll charge you their 6%, 7% fee, and you still have to advertise the offering anyway. And that's going to cost you the same thing. It's still going to cost you a fortune in marketing costs to bring in the investors. Use tier 2, tier 1's a waste. The SEC, you might think a government bureaucracy, given the country shutdown, would be shut down. They are open, guys. They are open. I am so impressed that this bureaucracy is open and conducting business, and we're not seeing any delays in getting fines done through the SEC. Another thing to note is that there will be times when FINRA, when you have a broker-dealer you want to get on board, where FINRA will slow down and won't make clear why. And it can be for a variety of reasons, like they don't like the broker-dealer, where you may never find out what it was, but it took months. In fact, we've had companies give up on their broker-dealer arrangement because they never could see a light at the end of the tunnel. The advantage here to have already qualified your Reggae Plus before engaging a broker-dealer is that you are already live, and that delay doesn't cost you beyond the inconvenience of not having the value add of the broker-dealer. So FINRA's got a lot better. I think in the beginning they disapproved the Reggae Plus, but there have been weird recent situations where they slowed things down. Okay, 11:55. Marketing appeal in general, and especially in this environment. So we've started to see happen what I thought would happen with marketing in this coronavirus era that we're in. Initially in March, when the stock market fell apart and the volatility was remarkably high, we saw costs of advertising, the costs of raising money go up 25 to 30%. And since then, they've declined. And in recent weeks, they've been lower than they were before, so lower than they were in January. And I think that reason, which I did expect at some level, is because at the moment, we've got a lot of people stuck at home dead bored. And those of that group, those that have disposable income, want to be entertained, do something gainful, they're looking for alternative investments, and they're engaging more with other online activities, but including investing. So we're seeing far better social media engagement now than we would normally see, because there is, to some extent, a captive audience of people that are dead bored who are paying more attention to social media than they would normally want to do, right? I expected that to happen. It's happening. We've had some of the lowest cost of acquisition in the last 2 weeks that we've seen with some of our offerings. So that's a good piece of news. We've encouraged our companies to emphasize alternative investments because, you know, in this environment where the stock market is apparently so scary, which it's been, and who knows what's going to happen going forward because, you know, the Fed has been supporting the market so much. It's kind of tempting to wonder how much growth we'll see going forward in the public markets. Alternative investments are appealing. Dividend payments, when interest rates have been going down even lower as they are, companies that can justify or afford paying dividends, that's very appealing, more so than usual, again, in this climate. So I encourage you to look at that. The experience in China, where they've had more lockdowns because they've had more viruses that cause drastic problems that thankfully didn't make it to the US, unlike this one. The experience they've had is that the lockdowns accelerated internet adoption, and a lot of the companies that had accelerated presence during that time sustained significant stepped up engagement post the lockdown. And I expect that to happen with Manhattan's Free Capital and with online capital raising in general, because what are we doing here? We're taking something that used to be brick and mortar, fly everywhere, do it all in person based, and it's gradually moving online. And this lockdown period is accelerating that process. So that's the only good news here that I'm seeing. Obviously, if you have the ability to do something COVID-19 relevant in your company, that's going to increase the appeal of an offering that you're undertaking right now. We have a couple of lovely companies that we're working with in that vein. Okay, now I will go to the questions. I have some prior listed questions, and I don't know how many we have here, but let me look. See if I can start. I'll start at the beginning. As I said earlier, you know, we have finite time, but and I'll try and hit the most useful questions and those that I can answer, right? Maybe some here that I can't practically answer. The purpose of a broker-dealer, providing liquidity to present investors. So I touched on the liquidity issue. Essentially, because you've done a Reggae Plus, then once you've reported your first audited financials or your first management financials post completion of the Reggae Plus, then all insiders are considered liquid by the SEC, no matter what security they have, as long as they've exceeded their Rule 144 holding period, which is typically a year these days anyway. That doesn't mean there's liquidity, and there are liquidity constraints for insiders and shareholders that own more than 10% of the company. That's too lengthy a subject to explain in great detail. Question, after all the expenses are paid, how much would you have left over? Well, think, you know, if you're doing above a $10 million raise, then 10 to 12% cash cost is what you should expect. So 88 to 90% of the money should be available to spend. did I say you can't use financial projections in a Reg A plus? Well, you may not make forecasts. You cannot use projections. You can't say, oh, well, we only did 3 million last year, but we expect to do 6 next and 14 the year after. What you can do is you can present factual evidence with sources behind it. So the market we're serving is growing at 88% per annum compound and has been for the last 8 years. Here's proof. That's a good thing you can do. So you can allow the investor to draw their own conclusion that you may be able to harness that growth yourself. You cannot make the predictions about how fast you'll grow, how profitable you will be, because the SEC wants to protect, individual novice investors from being misled. And they want to protect the entrepreneur from being excessively optimistic, which, is a good thing. How do you position real estate investment offerings? Depends on the nature of the offering. But you talk about what the company does. So if you do multifamily, we have a company called Caltier doing multifamily commercial real estate. There are a lot of investors who want that instead of just residential exposure in real estate. And then it's down to what's your track record, how impressive is the team, what's the geography, what's the nature of the kinds of properties you're going to play with. But it is not down to, we'll grow this fast. Can't say that. Besides working with Manhattan Street Capital and utilizing your advice and legal counsel, well, from the attorneys we bring in, do most companies also need their own legal counsel? No. Not normally, but some companies already have their own legal counsel, not necessary for the securities transactions that we're discussing. The debt instrument mentioned for Reg A plus, it cannot be offered by a Reg D, but you can make a Reg D offering prior to or during or after a Reg A plus. You are allowed to do that. It can't be the precise same offering that the Reg A plus is. Typically, if a company does both, they'll have somewhat better terms in their Reg D. We are a project developer of solar and battery storage for rural electric co-ops. Do you see Reg A plus as a feasible option to consider? Typical projects in the 4 to 9 million CapEx range. So yes. The short answer is solar and battery storage is appealing to many people in the US in some of the states where they're concerned about a global climate change and want to vote with their feet to improve the circumstances of the globe, of the world, of our environment. So a company like yours that's addressing that can be very appealing. The 4 to 9 million range, it would be better to combine a few in one Reg A plus than to do one per, but that's a detail. I think that's an appealing offering on the face of it. If you're using Reg A plus, and if your company story is very compelling, what would be the recommended minimum and maximum amount of interest offered on a debt offering? Good question. In today's environment, what we see gaining investor interest is 6 to 10%, and really more 8 to 10%. But it's a moving target because the rate of interest has gone so much lower so quickly of late. But it'll start to normalize slowly. But I would say 6 to 10% is the range. We see some companies that want to offer higher rates for various reasons, like 12%. That's the range I would think would be appealing. In your experience, what impact has a previous Reg A plus round had on the interest of other types of investment from angels or VCs? Great question. It depends on how appealing the company is, because if you're really successful, they don't care. And if it's complicated, having more investors than they would like, there are ways to solve that problem. You can solve that problem yourself by having an investment vehicle, an LLC set up where all the investors invest in it, and it becomes one investor in your company. that's a legitimate reason to do it, to preserve the interest in your company later to VCs and angels. I recommend you think about that. But when push comes to shove, if they love your company, they are not going to allow the fact that you did a Reg A plus to be a problem. And in many cases, it's an endorsement because you got that SEC qualification and you had the success of raising the money. For biotech development of drugs, what is the range of dollar investment under Reg A plus, assuming the story resonates and with investors in the time period from inception to close? So time period from inception to close in the offering is a year. You can do successive Reg A pluses every year, of course. You know, what normally happens is this, is that if the offering is appealing in the first place to a broad audience, you're not going to run out of investor appetite. Usually, rarely is that the case. And if it is the case, you pay close attention because the cost of advertising to reach out increases. And then you engage a broker-dealer if the company's offering is already successful enough to engage them. And then that's when they play a really good role. But we haven't seen that very often. Normally, there's a big enough audience out there to raise $30 million for a biotech company if it chooses to. If it's appealing enough, you're not going to be usually limited by the size of the audience that you can reach. Please, I understand the disadvantage of being a broker-dealer, but why some are broker-dealers? What are the advantages? Oh my God, there's loads of advantages to being a broker-dealer. They can charge large commissions. You know, our fees would be much higher if we were a broker-dealer. My company would be making a lot more money. Broker-dealers can do IPOs as underwriters of them when they've got themselves situated well enough. It's a great business to be in if you're successful at it. Just comes down to being good, right? I don't downplay that. And there are great broker-dealers that we work with that really are interested in our companies when we bring the right ones to them, and we know who they are. So yeah, no, nothing wrong with a broker dealership at all. I just want you to understand what they're good at when they're good at it. Don't delude yourself about it otherwise. 10% goal, that must mean you think it's too high. You know, the advantage, the disadvantage is if you've got, for example, a VC firm wanting to invest, then you can get the money now, You're going to get more dilution than in a Reg A plus, but you're not going to have to wait. You're not going to have to go public with an offering which publicizes everything about your business. And so a bird in the hand versus two in the bush. You'll have to give up a board seat or two. You run some risk of losing control later. But hey, you know, if you've got an opportunity from a private equity firm or a VC firm to take a sizable role in your company and fund it nicely, go for it. You know, don't just casually drop that. Many law firms are practicing as they go along, but we prefer to use for securities transactions in Reg A plus. We prefer practice folks where possible. At the end of the day, if you've got a law firm you love and they have what it takes, then great. Because only a broker-dealer can legally be paid a commission for the efforts to sell to offering investors, well, this is an answer. The risk of using a non-broker-dealer to sell the offering, yeah, of course, you can't pay commissions to any non-broker-dealer. That's absolute no-no. We don't charge commissions. There's no way in hell we would dream of doing such a thing. Success fees are broker-dealer territory. Maximum number of investors in an offering. Can you post Reg A plus approximate to going public for a small enterprise? Not quite sure about approximate to going public, but there are no maximum number. You know, one of the issues we find is that companies are nervous about having to entertain a lot of investors, understandably. You know, you've gone from having 8 investors, private investors, suddenly you've got thousands of them. It's a pretty scary prospect. The transfer agent, we normally want to use a transfer agent. They will normally deal with them. Somebody wants to transfer a title of their shares. They want to inquire about something. those sorts of things are dealt with by the transfer agent at a nominal expense, but it is an ongoing expense. There's a thing called Section 12G, where companies that are a certain valuation and a certain scale that conducted a Reg A plus, if they have a lot of investors, as you will typically have, are forced via Section 12G to become an S1 filing company with the quarterly PCAOB audit that goes along with that. There are ways to, there are legitimate ways to prevent that, but that's not something I can get into here. Where the owners of equity in the successful Reg A plus is selling their shares in terms of secondary trading platform or marketplace, about 70 of the Reg A plus companies who've raised money are listed on one of the OTC market type exchanges. There's 11 that are public on the NASDAQ, one of actually 10 and one on the NYSE. But about 70 altogether, counting the companies that are on some of the lesser, on OTCQX or QB or one of their lesser bulletin board kind of exchanges. Not that I recommend being public on those listings, because maintaining a decent share price and doing that at the same time is remarkably challenging. There are companies that have secondary markets for trading post Reg A plus offering shares. Not very many. Some of the broker dealers that are involved offer that liquidity. Yeah, I'm seeing answers to questions in the list here. The SEC must qualify the Reg A plus offering before any sales by any person can begin. Absolutely, yes. In fact, one of the things the SEC cares the most about is that if you're doing a test of orders, any kind of promotion of your Reg A plus before it is qualified, they really care to make sure that you do not accept any investments or any binding commitments of any kind. That's really important, because you don't have a qualified offering. You may not do that. What is the public acceptance of non-voting common stock or super voting shares that are Reg A plus? It seems like the use of non-voting is growing. Yeah, that's a good point. Non-voting is in some cases popular, or having the founders have super voting rights, you know, where they get 2 votes per share or something of that ilk to protect their ability to control the company, is more popular. Most Main Street investors don't evaluate that kind of consideration very much. We as a platform, and you as the CEO of your company, we need to be careful to protect the investors and inform them well during the whole process. That's obvious, I think. We want to have happy long-term investor relationships. We don't want them discovering stuff later on that they didn't know to ask about in the beginning, right? So proper disclosure and having reasonable policies in the first place is the order of the day in my book anyway. I've experienced auditors jacking up the price. What a nightmare. Yeah, I've seen it. It's horrific. I cannot begin to explain what I've endured dealing with my auditor. Yes, first, yeah, I'm not going to go into great detail there. It's reading a story somebody else. You guys can all be reading it. So I wish you good luck, Gilmore Holmes. And if you want to get involved with us, let us know. But you may be already sorted. What is your view of a strategy that calls for a private placement before a Reg A plus that A, converts into Reg A plus shares, and B, accounts for a majority of the raise? It's a good idea. It took me ages to get a securities attorney to believe that that was even possible, to agree. I thought as a matter of theory it should be doable, and it is certainly doable. It's very attractive. If you have investors who like your company, they're more likely to invest in your company to fund the Reg A plus expenses in a convertible note that converts into investments in the Reg A plus. You can give them a discount for doing so. You can step that discount so the early people who jump on that instrument get a better discount than the ones that come in later. And you are offering them shares that will be theoretically at least liquid instantly when the Reg A Plus goes live. And you then have the immediate success of, well, we've got $4 million already raised, minute one, right? I think it's a lovely strategy. To do a direct listing, yes, same thing. If you raised enough money, then you use the Reg A Plus to get enough investor count, because through a Reg D, you're probably not going to get anything like enough investors. Once you've got enough investors as well as enough capital raised, then a direct listing is a beautiful thing, and I'm looking forward to doing those. Seems to me it's just a matter of time. I have contacts with quite a few overseas companies that want to raise capital. Reg A Plus will work in that situation, but it's not like they can't do it in a fabricated, artificial manner. They have to have a real US entity or Canadian. It has to have real board members and executives that are not fly in, fly out folks. They have to be resident of the US predominantly, right? If you've got a board of 8 board members and 6 of them are residents and 2 of them are fly in, that's okay. You don't have to have a board of that size, but you get the point. It has to be legitimate. And that, frankly, was the thing which, forgetting the name of the company because it pisses me off so much, that did it wrong, where they misled the SEC. They were an offshore company masquerading as a non-offshore company. If they can justify the expense and hassle, and we'll help them set up in the US if they need help, then it's a good thing. Please email me. I don't have your email address. I'm going to type in my email address here, so you guys could all email me directly if you want to, for questions to follow up. Hopefully I'm typing it right the first time. I'm sort of dyslexic. There you go, that seems to be correct. So feel free to, did it go in? That's shoot, I sent it to him privately. I'm going to send it to everyone in meeting. Okay, you've all got my email address there. So I'm at the end of my material and I ran out of time. So I've answered the questions, it seems. So we should probably wrap, guys. If you have a couple last minute questions, put them up. Otherwise, we're done. Hopefully you've enjoyed this. I have. And yeah, so feel free to engage, ask us questions via email afterwards. And I hope we can help you in other ways, and I hope we can partner with you and take your company to a better place. And I've enjoyed this, although it is a bit weird looking at myself, seeing the lines in the face and all that, and the scruffy hair, courtesy of not having a haircut for a long time. So thanks, guys. Really hope this has been helpful to you. And I'm going to wind down. I guess I'm going to wrap up here. Thanks. We will, one important thing, we did actually record this one. We screwed up last time. We will be converting it into a clickable indexed blog post, which will take a little time. And when we've done that in a week or 10 days or so, we will send you a link to that so you can check back and get bored all over again with the same content. Thanks, guys. Have a great day.